Thanks to SALT, New York Conference, and thank you for joining our panel discussion today on improving access to capital for diverse founders and managers. My name is Vaughn Crowe. I'm one of the managing partners at Newark Venture Partners. I'll be your moderator this evening. Newark Venture Partners is a seed stage B2B investment firm, national seed stage firm, investing out of our second fund. Equally as important to our performance, we're really proud that over half of our investment team, the decision makers inside of Newark Venture Partners, is comprised of persons and people of color and women, and over 60% of our portfolio across two funds are comprised of founders of color and women as well. Before I get into the meat of it and introduce my esteemed panelists here, I just want to lay out some facts for the audience to have an understanding of why this issue is pretty important for us to talk about today. In 2021, a study of diverse asset managers conducted by the Knight Foundation found that only 1.4% of total US-based AUM in their sample size of 82 trillion is managed by diverse managers. The study also found that no statistical significant differences in performance between diverse and non-diverse managers was there anything significant. Similarly, Crunchbase's Diversity Spotlight found that despite record-shattering venture investments in 2021, Black and Latinx female founders did not receive proportionate capital to start their businesses. So these are just real data points, real issues that we're trying to address. And hopefully at some point this topic moves to a bigger stage, a larger audience, because it's important and there's money to be made in this sector. With that said, let me introduce my panelists. First, I'd like to introduce Jason Wood. Jason is the managing director with Morgan Stanley Next Level Fund, focused on investments in women-led and multicultural founded early-stage companies. Before joining Morgan Stanley, Jason spent 6 years leading AIG's direct equity, venture capital, and private equity co-investment business with responsibility for sourcing transactions, executing on high conviction investment opportunities, and overseeing the investment management process. Jason, welcome.
Thank you very much, Vaughn.
Jasmine Richards, who actually opted to moderate this panel today.
I did not. Opted out.
Jasmine is the head of diverse manager research, the diverse manager research practice at Cambridge Associates, a global investment firm investing on behalf of high net worth individuals, public and corporate pensions, endowments, and foundations. She's also originally from Queens, New York. So yes. Welcome home, Jasmine.
Thank you.
And thank you for being here.
Absolutely.
Omar Issa, Managing Director in Investment Banking at Bank of America, specializing in M&A and capital raising for portfolio companies of private equity firms. In addition, Omar, recognizing the need for greater diversity and broader access to capital in the industry, also co-leads an effort focused on utilizing bank capital to seed diverse managers and diverse founders. Omar, thank you for being here and welcome.
My pleasure. Thanks for hosting.
And last but not least, a little bone to pick with him. Jackson graduated from Stanford, and Stanford beat up on my Colgate Raiders last week, 41-10. So we'll see how this goes today, based on this rivalry we have. He's the head of Wellington Access Ventures at Wellington Management, where he leads a platform focused on diverse early-stage companies and venture capital funds. Prior to joining Wellington Management, Jackson was an investor at Salesforce Ventures, where he led investments in various equality initiatives, including deploying capital into Black and underrepresented founders. Jackson, thanks for being here.
Thanks, Vaughn.
So let's jump right into it. And this question first to you, Jasmine. We oftentimes hear about the need for managers to have a track record. And I faced this personally as I emerged from a family office where that track record is often sacred and private. But it's important for allocators to be able to identify a track record. How do you think about that at Cambridge? And how do you look at managers who may have taken a different route to either venture capital or private equity to help you in your decision-making process to ensure that there is democratization of capital across founders who take a different path?
Yeah, I feel like you're diving right into, I think, what is the core of probably what all of us are thinking about. every day, because we all know that bias exists in the world, but I also think that there are systemic problems and barriers that actually are very impactful that we don't hear about as much, right? Like what you raise of if a standard part of a due diligence process is presenting a track record to say, I've been doing this, therefore I can do this, which there's no malicious intent in asking for something like that. If we know that venture capital was started, right, like maybe 5-10 years, right, like after segregation, right, like there are issues with asking for that and thinking that everyone's on a level playing field, right, like with having access to those requirements. And so what we try to do is thinking about how can we invest equitably, right, like how can we take that standard checklist of what we're all asking for in our diligence process and be more equitable about those requirements. So continuing on the track record example, it's maybe we all know that there's underrepresentation in the industry, right? So the odds that someone is a spin out, which we all love and can easily get comfortable with, right? Like the odds that someone that is a woman or a person of color is a spin out is pretty low. What you're seeing more often are people like yourself that are coming from other different paths and then entering the industry. But really what we're trying to assess is a skill set, right? Like not a specific track record. And so what I think we all have to do is unpack that checklist of what we're looking for and think of other ways of assessing those. So we were early investors in a fund where the two GPs were coming from different backgrounds, using the massive amount of contacts and data that we have at Cambridge, whether a person does or does not have attribution. I more likely know a founder that has invested with that person. I more than often probably have other data points where I can validate pricings on a deal. I can call up the founder and say, did this investor add value? I probably know other LPs that have invested, right, like with that family office. And so what we need to do is really just like roll up our sleeves and do more work so that we can get to better decisions. In that 1.4% that you mentioned, that's the AUM. In that same study, diverse managers, which is still a massive underrepresentation, but they actually represent 8.6% of the universe, right? So we're not even investing on par. And so what that data tells me is that we still have a lot of work to do just to even get to an equitable point where we're at least investing on par in the universe.
Very helpful. And that 8.6% is really important. And I think we kind of gloss over that important component. We talk about track record for fund managers. We also have this challenge as an investor when you're looking at founders. So Jackson, how do you think about, we have this rubric every now and then. It's like, hey, repeat founder, former VP of sales here. But sometimes you just have a hungry and thirsty founder who just wants to grind it out and build a big business. How do you think about that when you're looking for investment opportunities in founders?
Yeah, it's a great question, Vaughn, and like similarly, as you mentioned, Jasmine, there has been some systemic, real problems that founders have faced head on. A lot of that is that access to capital point. Some of it is that access to either mentorship or potential, connections that could be either acquiring companies or from founders like them who have built businesses in that similar sphere. And so I think some of the things that we think about when we kind of take a step back is, look at the U.S. Census. By 2045, they expect the U.S. to be a majority minority population here in the U.S. And then at the same time, when you take a look at where innovation is being built, new technologies, new businesses looking to solve problems that we are facing here in society in our is one of those things that when 1% of venture capital dollars go into the hands of either black founders and roughly 2% or so going into the hands of Latino founders, still make up trillions of spend here in the US from a consumer basis. And so when we step back and take a look at the founder set, we're really looking for founders that are looking to build big businesses that have the opportunity to be, sort of the next generation's unicorns and standalone businesses. And so really trying to understand those that have massive visions. And part of that is being able to provide access to those founders, to be able to have some of that mentorship, have those relationships that, are looking to solve the problems that we're going to face for the next generations.
Great. And Jason, on this same line, so you have the challenge the lack of access to capital for founders. The other part of that is there is this misnomer out there that it's hard to find them. And so at Morgan Stanley, you're part of the Multicultural Innovation Lab, you're with your fund. How do you dispel that myth that it's hard to find great founders of
Absolutely.
color building big businesses?
I think one of the key areas that we've done really great things at is, like you said, filling up that top end of the funnel, working both domestically and in the UK to find underrepresented minorities that have excellent business ideas at the sort of pre-seed to seed stage that can benefit from the Morgan Stanley platform, as well as from a lot of the resources that we're able to bring to bear through the Multicultural Innovation Lab. And as an outgrowth of that, the Next Level Fund is able to provide capital, not just sort of at that seed stage, which I think is well represented here, and we have a great opportunity to provide capital at that early stage, but at that next step, right? So sort of post-seed, the Series A, Series B, to help these businesses continue to grow, to help them find that sort of next solution that a lot of these enterprise customers are looking for. So like you said, the misnomer that there aren't a lot of founders of color that are out there, or women that are leading businesses that are out there that are deserving of capital that can generate commercial returns for investors is just that, a misnomer. I think the MCIL, the Multicultural Innovation Lab, has a portfolio of 60 different companies that they've put together over the course of the past 5 years under the guidance of Carla Harris and Alice Vilma. The Next Level Fund has a portfolio of 10 businesses that we've put together already so far over the course of the past year. So we're not having an issue finding these founders. I think one of the points that you've discussed and that the panelists have already covered is just getting access to the capital that they need to really grow these businesses in a way that is sort of on level playing field with the rest of the market.
Great, thanks. Now, Omar, what I didn't say about Omar in my introduction of him, to date, Bank of America has backed over 130 early stage firms, with LPs investing a total of $400 million. Now, Omar, Bank of America, to my knowledge, doesn't or did not or doesn't have a venture program. It doesn't have like an asset management platform for where this is kind of a principal focus. It appears to me that you took an approach, your firm, your company took an approach with no track record in doing this, went out there, as a maverick, deploying capital. Tell us more about that, because in my opinion, that's uniquely different from some of the things that we've seen before.
Yep, we, thanks, Vaughn, for that. We actually have, I would argue, the luxury of being able to design this program with everything you all just said in mind, and we recognize that not having an asset management business, not traditionally having a venture business, we weren't the experts in the room. So we had the luxury of our CEO, who was post the events of George Floyd, willing to commit balance sheet capital for us to go out there and learn what we can do in the market and where we're best positioned. And we listened to folks like this and realized our capital, being that it's not institutional, it's not high net worth investor capital, it's not other people's money, so to speak, it's our money. So we can decide the parameters by which we wanted to invest. And we really thought to ourselves, we should take an approach that is A, catalytic, and B, disruptive in the market. And so we, by design, initially allocated a $200 million pool of capital. Senior management saw the momentum we'd built and upped that number to 350, and likely will up that number again. But the point is, we designed this program to be broad. We've backed 130 funds across the country with checks in the order of $1 to $5 million. And the idea was, we're an institutional LP for oftentimes very early stage, first time funds. So the point about not having a track record, we were willing to put our hands up and say, we'll be your first dollars. We'll be an institutional backer who hopefully then you can take out into the market and say you have institutional support, and you can go raise more money. So if you think about the 130 funds, 375 million of capital committed to date, those funds reaching their fundraising targets should generate about $4 billion of capital that's out in the market looking for diverse entrepreneurs and willing to follow them stage by stage and building companies that, really get the rest of the market paying attention and comfortable with the value creation. And the key point about this and why I really love this program is this triple layer of effect in theory that we should see take effect over time. We're happy to pay 2 and 20 to a diverse fund management team that can go generate value with a founder who will then go hire in a more, more thoughtful way going forward, given the demographics of our nation. And so that is absolutely value add in our mind, because what functionally happens is you also get the next class of asset managers. And as Vaughn, as you noted, my day job, is doing leveraged buyouts for private equity firms. And the one thing I've always noticed throughout my 12-year career doing this is I'm usually the only diverse person in the room, right? And that's, I committed my time, and there are folks across the institution who have committed their time to building this program in addition to their day jobs, because we want to see this change. And we know that there are people out there on the front lines doing this work, generating value, building pipelines, giving founders resources that they need. And if we can just kind of stand up and play matchmaker and give folks more firepower, this is how ultimately over time I think it's the push and pull of getting this change into the market. And so in theory, these 130 funds and hopefully more over time, there will be some real stars out of that who come to Cambridge with a real track record and can go raise, real institutional capital from pensions and, insurance and the whole 9 yards. And then we're talking about not $100 million funds and $200 million funds. Now we're talking about $2 and $3 billion funds who have the right mindset about investing in this new world.
Yeah, I like that. Omar, one thing you said in your comments is, we have $350 million allocated today, likely to do another. And just to push a little bit there, it's no surprise that the unfortunate tragedy of George Floyd sparked something in our country, where there was an increased recognition of the lack of access to capital to founders and to fund managers. I felt it when I was raising capital in that environment. Was that a moment in time? And we all represent institutions. Was that a moment of time in time? Or do we think it's sticky? How do we, Omar, maybe I'll start with you as a follow-up to your likely to do to get some perspective.
So I give a lot of credit to our chief executive, Brian Moynihan. He, before discussing this across the institution and crowdsourcing an answer, he came out and said, we're putting $1 billion towards racial and social justice efforts. We'd already been very active in the community, but, it was leadership that he was showing and expecting other bank CEOs to follow, as well as just broader corporate America. So that was catalytic in nature. The key was this was the first time he and the institution really committed to investing equity dollars. Before that, it was always philanthropic, right? And part of why I'm really emphasizing that this is a program that's here to stay and it's how we do business going forward. That's why it was equity, and that's why it wasn't philanthropic, right? Because we believe in the value of capitalism. We believe in the value of getting entrepreneurs the dollars they need to go generate the next economy we're growing into, right? And our institution is hyper-local. Like we are in almost every market we touch, in one way or shape or form, either small business or personal relationship, we touch half of the families in this country, right? So we can't afford to silo ourselves with one demographic and think that everything's going to be okay. This is part of how we do business, because this is how our customer base is going to look going forward. And the last piece of this that I love is that we're going to get some amazing businesses out of this that are diverse founders who, will be the next IPO targets and will be, the next $10 billion leveraged buyout. And that's when people really start
on that, I like the self-interest, because that speaks to the idea that you're focused on returns, such that, so this isn't a concessionary investment.
Nope. It's not meant to be concessionary. It's meant to prove the point that diverse founders need access to capital because there's an amazing opportunity for them to generate value, right? And the smartest thing we did, I think, frankly, is recognize that we're not best positioned to chop that up and make all those decisions ourselves. There are folks like Newark Venture Partners who have been doing this, right? And the fact that, with returns that they've posted, they, aren't putting up even bigger fund sizes, we were like, absolutely, we want to be a part of this, and we want to see them do Fund 3, Fund 4, Fund 5, and Fund 6, and those to get bigger and bigger and bigger and bigger. And, you can look out into the marketplace now, and you've got some real diverse investors in the private equity world who've generated a lot of value, the Robert Smiths of the world. There should be 50 more.
Jazz, I'm going to come back to you on this one for a moment, but I want to hear from Jason and Jackson on a similar question, but with respect to founders. We're now starting to see more capital, at least it feels that way, But how do you think about it as it relates to a committed effort to ensure that diverse founders, Black, Latinx, women are gaining a fair share of capital, similar to how Omar said it's not a moment in time, but it's sticky. Do you feel the same way?
Go ahead, Jasmine.
Yeah, definitely. I'll get started here, Jason. 100%. And I think part of how we think about not only non-concessionary returns, but you have to look at the history of where founders from different backgrounds have been able to exit. Because I think that's a question that a lot of us probably get and hear is, okay, well, this sounds all maybe great, and oftentimes we may be sitting in a seat where we think, well, is this diversity theater? Like, why are you doing this? And then you start to look at the numbers, right? And I think over the past, few years, there's been north of 40 companies led by Black or Latino founders who have, raised either north of $1 billion, exited north of $1 billion, or are now standalone businesses in the industry. And what happens when those sort of events happen is they will then go back and mentor earlier entrepreneurs. They'll go out of their way to spend time, office hours, coach sort of what does this go-to-market look like, moving your company from 1 to 10 million, 10 to 100 million, so that you have the opportunity to get bought for a large 9-figure sum or even into the billions from an acquisition or become a standalone business. And when you start to have more of that critical mass of these leaders in the industry, you're starting to see sort of this trickle-down effect of seeing businesses that are growing at faster speeds. And so I think that's something that, when you do take a look at the numbers, you're starting to see not only these exits, but then there's been multiple studies done, and I'm sure this is something that Jasmine can get into, and Omar, I'm sure you've seen, and Jason, but, when you look at, organizations like, Kauffman Fellows and others that have data that show that, diverse-run venture firms show some outperformance across compared to non-diverse counterparts, I think you start to, get an understanding of there is a real business here. Non-concessionary returns can happen, have been happening, and in our opinion are going to continue to happen. So, but maybe I'll pause and see if there's other
No, I absolutely agree with you. I think viewing this as a 100% commercial enterprise, right? A focus on getting these founders the capital that they need, not just in the initial round of funding, but working with them on their cap tables to ensure that they have growth equity investors that can help to support them as they continue to grow, like you said, from 1 to 10, 10 to 100, 100 to $1 billion of evaluation, and bringing the resources that they need to bear. So it's not just capital from sort of the Morgan Stanley balance sheet or from the B of A balance sheet, but from the limited partners that we bring to bear as well. So thinking Microsoft, Walmart, Hearst Media, other people that have not just capital, but can also provide the resources that these businesses need on the technology side, on the growth and development side for the leadership teams to ensure that they're continuing to grow. To Jackson's point, once you have 30, 40 of these exits, you have a group of people that are committed to continuing growing the base of diverse founders that can come back as second, third time founders and have real equity ownership of these businesses as they continue to grow. It's a very, very powerful tool that we want to help to continue to perpetuate. So all the annuals, all of the statistics that Jackson mentioned, and I'm sure Jazz is going to go into this in a lot more detail than I can, are relevant. I think it's an exciting time to be where we're at and to have the support of the financial institutions and the collective companies that are represented here on this stage, and the commitment that they've made top to bottom to making sure that this is something that isn't just something, as you said, post George Floyd, but is, on commercial terms, a venture capital effort that has 10, 12 fund year lives and is committed to fund 2, fund 3 for our team and for other teams to continue growing these businesses is critical.
That's good. And Jasmine, you see it from a number, a different perch where pensions, endowments, university foundations, along these same lines. Two-part question. Is it sticky? And is it viewed as impact? Like, how do we, is that where we get pushed?
Yeah.
We'd love to just hear some perspective on that.
Yeah, I think to your first question around, is it sticky? I would say it's still up to us, right? Like everyone in the room, everyone, right, that is in the market, it's on us to still determine that, right? And what I will say is, what I appreciated about 2020 and the time since then, it does feel like stakeholders are being more thoughtful about how to make it sticky and to make better decisions. We certainly got approached several times to invest in strategies that we felt like were more reactionary, right? Like it wouldn't have that lasting impact. And quite honestly, that's not work we were interested in. We recently did an update. We have over 30 clients that have literally coded in their investment policy statement information around their intentionality around diversity. To me, that's going to be much harder just to forget about 2 years from now, 3 years from now, right? Like you're going to have to intentionally remove that focus. And when you think about changing the ways that capital flows, that has started, right? Like with the work that has been done at Bank of America, those fund managers, whether feelings and hearts change 5 years from now, have been able to build those track records, and they will always have that. The founders that they funded will always have that experience of running that company. And so I think the way that we've built different programs or intentionalities, there's obviously been a lot of ink spilled of people made commitments in 2020 and where have we seen the results. My response would be, this is a marathon. I don't want you to see that response in 2 years, right? We're managing long-term portfolios that certainly our clients do not come to us for concessionary returns. And the meetings that we have when we are reporting to investment committees, I don't think there is any tolerance for concessionary returns. But the stats that you just look at in the Knight Foundations, it has been proven, right, like that there is no trade-off in returns of investing with diverse managers. And I think that attitude comes from this idea of, oh, you're constraining my hands. You're telling me I have to put money with women or people of color, and therefore I am limiting my investment universe. I think that view rests on this assumption that we have already been making equitable decisions. Right? So in theory, if we had been looking at everyone and giving everyone a fair shot, and now I'm telling you to focus on a subsegment of the population, then yes, that would be limiting. What we're actually have seen from the data is that we have been constraining ourselves. We've been operating with the constraint in our mind, in our vision, in our networks that only white men are capable of managing money. And what we're saying is intentionally, let's think expansively. So I would argue what we're all doing is increasing the opportunity set for all of asset owners, all of our portfolios, which then, can create the opportunity for better returns. We're all better off.
Got it. Really helpful. And to push on that, Omar, this is more of a personal story. Young fund, Vaughn shows up on a call with an allocator. He appears, as I do, black man, and I have Newark in my shingle. And there have been times where on that call, before seeing my deck, before hearing our performance, it's an impact, right? So how do you, and some of my peers who are GPs have had similar experiences. And I'm fine with being called impact because I think as a part of our business, as seeding the next generation of large corporations, that has an impact. But I'd be curious to know how within Bank of America, Omar, do you guys think about impact? And again, you already answered the question that it's not concessionary returns,
Yep.
but just curious to hear your thoughts there.
Look, our institution, it's key to our DNA to be active philanthropic in our communities. Again, this is designed specifically to not only prove a point, but this capital that we put out there in equity as opposed to grants, if you will. Our view is we're going to get a 2x return on that. Like that's what internally people believe, and that's what the data is starting to show, and that's what we underwrote in the deals that we did. That 2x is going right back into the community in the exact same way, and we'll do it again, right? And the goal in our mind is to double down on this and make sure that other folks can kind of follow along. But really, like I said, we're building the next class of clients, right? And in my mind, in our investment in Newark Venture Partners, our expectation is that you generate a return, that you build companies.
Well, thanks for looking me in the eyes and telling me that.
Right? And really, no, is that you build companies, right? And that has an impact in each of our local communities where where we operate and our business is built. And so, like I said, it's that triple layer of impact. We want you to get wealthy. We want that founder to generate value. We want the employees to be treated well. That helps our company.
Jasmine, anything to add there?
Yeah, to me, I think it's you can't have the reason we built our team within Cambridge Associates, we have a large sustainability and investing practice, and my team is intentionally distinct from that, because what I also think shouldn't be on the shoulders of women or people of color is also changing the world in addition to running an investment fund, right? And so when you force, managers to be in that impact bucket, then what that means is I'm also asking you questions not only about your investment strategy, your team, but now I'm also asking you, but what about your impact in the world, right? And I think women and people of color should be able to run a fund that isn't necessarily focused on impact, and they can have, a VC fund that's focused on consumer or fintech, right? We have to have, not put the burden of impact, I think specifically on this community of GPs. And so we intentionally look at those as two separate buckets. But obviously some investors think of closing wealth gaps as impact, and that's fine, but I don't think that necessarily should translate to the fund managers.
Understood. Thank you. Jackson, many founders don't have, I'm being presumptuous here, which is dangerous, but many founders, particularly those of differentiated backgrounds than what we read about, I'll say it that way, don't have the social networks, don't have the ability to fully access the friends and family round of financing to help build their big idea. Is it time for us to start to think about a new form of how to support founders who may not have equal access to a friends and family round? And then what does that portend for our industry as investors?
Yeah, it's a great thought, and something that at least me and some of our team have been thinking a lot about. And I think, when you make that maybe assumption, and I think if we all on this panel have probably seen that in the founder community where, a Black or Latino founder may not have that same support from a friends and family to get their business off the ground. But then if you think about it a little bit differently, okay, well, where are some of the pools of capital that can be sort of initial rounds of funding, right? And so I sit on the board of an organization called Black VC, BLCK VC, which is really a nonprofit that focuses on increasing the number of Black and brown investors in the venture community. We're active all across the US and have a growing membership base. And I think one of the things that we think about in that program are how can we go and tap into some of the best operators, the best diverse Black and brown operators from the large technology companies, banks, consulting firms, public sector, who have been running businesses at the director through VP, SVP suite for the better part of the past few decades. How do we bring these individuals to the table to understand, A, how to become an angel investor, how to think about building a syndicate, or being able to connect with some of our seed and pre-seed venture funds? And how do we grow this network? Because there's a ton of talented operators who may actually know how to be able to sign that first sales contract, who may actually run teams of hundreds of individuals who can go out and help with talent and talent acquisition. And so what we've done is thought about it from a programmatic approach and gone and really, in the past couple of years, been able to bring together a few hundred of the leading operators from across the industry that are now starting to write checks for those first-time founders, for some of those kind of pre-seed rounds, while also recognizing that, angel investing is a highly, risky asset, but also being able to put money into these founders, be able to support with the networks that they have, and then ultimately be able to build that into the broader kind of seed and pre-seed venture ecosystem. And so that's one way that we've thought about it. And I think in addition to that, and this is something that I'm sure you guys have a lot of the numbers around and background, but there has been a ton more diverse seed and pre-seed fund managers that have come to market. And these are going to be your first check writers. And one of the things that we're really interested in is being able to partner with some of these first check writers, the pre-seed and seed funds, that then, in combination of working alongside them, be that next accelerant in growth into the industry. And so, one way to think about it is there needs to be capital structures across the whole ecosystem, from mid-stage to growth, all the way up until you're a standalone public company, and then we're going to have another institutional set of partners. And so I think that's one of the things here at Wellington Management and Wellington Access Ventures we get really excited about, is being able to partner with our diverse founders from the early stages and being able to support over their life cycle.
Omar, any perspective on this?
Yeah, I just absolutely. I love the way you guys are thinking about that, because this has been, I would argue, it's something that we've complained about internally. Based on the Volcker Rule restrictions, regulatory restrictions on banks, we actually are only allowed to invest in venture capital. There's a specific exemption that allows us to invest in venture capital, but that's one form of capital, right? And not every business is necessarily, built for a venture track record, right, or a venture pathway. And so we've actually been doing work on the Hill and lobbying to try and figure out if we can kind of expand that exemption, and then we can go do credit, we can do hybrid structures, we can do real estate and all these other things. And again, our view is you build this class of asset managers, they have the right idea, and that will then trickle down over time in a sustained way. So at very, very important point, I think, and the venture capital firms that we backed, that we've spent time with, have this in mind. And I think venture is the traditional way to get to diverse entrepreneurs. We can debate why that is and whether that's legacy perspective of, how you think about a diverse entrepreneur. Maybe you can comment, Jasmine. But I think, a majority business has a plethora, a menu of capital options that, in theory, they can take advantage of to build a business in the right stage, at the right time, for the right opportunity. Right? So that's an innovation we as a team, all of us here, need to think about working on. We'll do our part on the Hill to try and create more opportunity, but really it comes down to, allowing these asset managers to build more diverse strategies.
Yeah. No, and I love that Jason earlier was mentioning that they're thinking intentionally around those other stages, because honestly, it's something that concerns me as an investor in this space. We did run the data checks, and if you look at, we looked at two vintages, so 2010 to 2013 and 2019 to 2022. Within privates, you've seen a 3x increase in the number of women and people of color owned firms, right? Which, to be clear, is still a drop in the bucket versus the rest of the universe. But and the largest explosion of that, right, is within venture. And so I think of it as one of those structural headwinds, because when we're thinking about it from the portfolio level, if you think about just asset allocation, typically for any asset owner, that venture bucket is going to be the smallest, right? So we have the largest growth in the smallest bucket of allocation. I think of that as a structural headwind, right? We do need credit firms, we need fixed income shops and public equity, right? We partnered with a firm this year to create a index option, right? Think about the number of assets within that trillions that you mentioned that are in index, right? We don't have that many minority-owned index funds. And so specifically within privates, I think it's great that they're focusing on the later stages, because what I worry about is for all those founders that have been able to climb that hill to get funded at those early stages, what does that mean for them? When they enter a growth stage or when they're trying to be a buyout company, are they then going to receive that same haircut because they don't have the receptivity and access to capital?
It really is the education around that as well, right? When you're trying to build a business from the ground up and you're struggling to raise capital, that first yes that you hear is sometimes dangerous, right? You don't know exactly who you're aligned and working with. So having the right set of hands, the right team around you, both from a mentorship standpoint and from a capital raising standpoint at each of those stages along the way, on the equity side, on the credit side, even on the fund side as you're continuing to grow, making sure that you know your partners, making sure that you can come around a group of people that are thinking about things in the exact same way that you are, that are there to provide that sort of perspective is key. And so I think everyone here on the stage is committed and dedicated to that, and works for firms that are committed and dedicated to doing the same thing as well. Just really making sure that we build out that ecosystem and connect the ecosystem, I guess is probably a better way of putting it, because all these pieces are already there, right? It's just making sure that we have the right people talking and making sure we're connecting in the right way.
This is great. Jason, just really quickly, you mentioned earlier, either in the green room, that you've had support from the top down. Your Vice Chairwoman, Carla Harris, Alice, and a handful of others. Can you just, it's going to take a lot corporates,
Oh, yeah.
pensions. Can you just talk about, or maybe give some tips to those who may have influence as to what you've seen from the top at Morgan Stanley that's helped
Absolutely.
drive?
I think from the top of the food chain, everyone is receptive to commercial ideas, right? So if there's a way that we can both improve the community and make money doing it, everyone is all ears. And so one of the things that I asked to a question you had earlier before I joined the team at Morgan Stanley was to the head of our HR, Mendel Crawley. Is this just sort of like you said, a moment in time? No, we're committed from James Gorman on down. The head of private credit and equity, David Miller, is very much focused on this as a commercial enterprise and helping us to build this business going forward. So to Omar's point, having that support internally, right? Having a group of like-minded people who are saying this isn't just something that we can do to help out. It's a way that we can make money in an untapped market that it benefits not just us, but our shareholders and the community to go after this, to really make this a solid business is key. So choosing your partners, like I said before, making sure you're at the right institution. And if you're not, trying to build that ramp while you're there. If you can't, finding another place that will allow you to continue to grow and build those efforts.
It's just by show of hands, you're here, you sat through 45 minutes. Is this topic is this important to those in the audience? Just show of hands. Okay. And do you feel like you are empowered to do something about changing this paradigm that we're in? By show of hands. Okay. Well, if you feel empowered to do so, I would further encourage you to do it. This is not the four of us here talking for the sake of it. We're all in this together, not just for the sake of, it is the right thing to do, democratizing access to capital for those who've been deprived for so many years. But the reality is we're capitalists and we're here to make money. We're here to generate returns. We're here to have an impact, however you so define it. But we're at a moment in time that has longevity. Jason, thanks for being here with us today and representing Morgan Stanley and all that you do. Jasmine, it's been a real pleasure to meet you in person and to have this discussion. Omar, thanks for your commitment, both professionally and to our panel today. And Jackson, go Colgate. But thanks again for...
I think I had to bring you.
Fair enough. Thanks, everybody, and thanks for coming.